Welcome everyone to Capital W Collective's Fundamentals of Pricing. This is our first session. We're calling it The Basics. I'm Amy Creason. This is my good friend Deb Jones. We are board members of Capital W Collective, and we're so glad you're here taking a look and coming to understand a few things about pricing. This is the basics, and so we're going to be covering some very fundamental elements while having some fun here. And if you're not familiar with Capital W Collective, we are a nonprofit focused on bringing more women and underrepresented groups into the special place within the mortgage industry, capital markets. Our mission is to create more inclusive and dynamic mortgage capital markets, one woman and ally at a time. And there are three basic tenets within Capital W. Educate, so to create greater awareness of these career opportunities, as well as provide free and accessible education. Elevate, so encouraging others to join this special space. And finally, empowering by inspiring women and their allies to foster greater belonging and inclusivity within mortgage capital markets. So we're here and hopefully going to have a little bit of fun while we teach you a few things.
So our format really is, we really want you to enjoy this fun, casual video and accompanying presentation. We are trying to provide the building blocks to advance a more comprehensive understanding of pricing. This will allow you to learn at your own speed, stop, start, restart, and re-listen to the video anytime. You say you're not a math person, no problem. There are no graded assessments. You're investing in yourself, and we're glad you're here. If you have questions, submit a question to info@capitalwcollective.org or hit us up on LinkedIn. We'd love to interact with you after this session. The suggested audience for this particular program, it's really recommended for any mortgage banker or business partner seeking instruction on the basics of mortgage, loan officers, your lock desk, junior analysts, finance partners, ops, loan delivery, risk, auditors, QC, anyone. And, you know, just think about those connected in the whole mortgage ecosystem and wanting to learn more about the pricing and the secondary market. While the specific presentation is not for the advanced pricing person, it can certainly be a refresher for anyone in and around capital markets as well. So you can access this via our website at www.capitalcollective.org to access the video and the presentation material.
Well, why don't we just jump in on the basics of mortgage finance? So might seem a really low basic place to start, but it is truly fundamental to understanding all of pricing. We all know that the borrower applies for a loan. That seems like the starting place, but really there's a lot more that goes into that borrower pricing that is much further down the highway. But just in general, we're going to speak to the process as the borrower applies for a loan, that lender funds the loan, in the mortgage capital market space, which is where we're going to spend the majority of our time in these sessions, and especially at Capital W Collective. Speaking of those activities, mortgage capital markets is really kind of the core portion of a spoke, if you think of it as a wheel. And that where you're going to sell the loan or what you're going to do with the loan really influences both the front end as well as the back end. So, of course, once the loan is closed and if the loan is sold, if an entity decides to retain the loan, mortgage payments are made. So that's the servicing piece. And we'll talk more about that servicing asset and what that means from a valuation and pricing standpoint. And then ultimately the profits that a company realizes both from the sale of the loan as well as the ongoing servicing. It is a process that continues over and over again. We're going to help you understand more of the process and how it might relate to something with which you're more familiar. Deb, how about we do a comparison of the mortgage banking process to something maybe a little bit more less esoteric and more tangible, which is goods manufacturing.
Right. So goods manufacturing. Think about raw materials, and then conversion of those inputs into a final product, and then selling those products and maintaining those products. So any good or service kind of touches the same process. And similar is mortgage banking.
That's right. So mortgage banking, what's kind of the equivalent to those raw materials would be capital, having cash to do something with it. That's the very first point. And in the next step of the process, loan application and approval and closing, that's very similar to the conversion of inputs in the manufacturing example. Loan sales, very similar to product sales. So selling the product to get more cash in. And then similar to that maintenance, that product maintenance component is the servicing process of a loan. So maybe not the perfect, comparison.
Yeah.
But there is something on that servicing side, especially as we think about servicing contracts once you sell a loan and what the servicer has to do, what they're required to do pursuant to those agreements. So we'll not go too deep in that, but wanted to give you kind of a, maybe a little bit more concrete example to compare mortgage banking to manufactured goods, that process. And with that process, then let's break down mortgage banking. So there are really two different markets that we tend to speak of. The primary market is the one we'll refer to as the direct selling of a loan to a borrower, and call it in quotation marks selling, because that is an exchange. It's an exchange of cash for a purchase of a house and a borrower's then promissory note to the lender. So the transaction is cash goes out the door to the borrower to fund the house or the refinance, and in return, that entity that did lending is going to be earning a yield, an interest rate, and doing something with that interest rate or that promissory note that they have, which is a collateralized obligation,
right,
and is available to trade in the secondary market.
And like you talked about earlier, the maintenance of it is the servicing and receiving those monthly principal and interest payments in that primary segment of the lender, the borrower, closing the loan, giving the cash, servicing the asset.
And then so in the secondary market, by comparison, there is a created asset from the primary market, right? That's where you get that asset to then sell subsequently in the secondary market. And it could be one asset, it could be multiple assets. So when you've heard about pooling loans and selling loans, might be one loan, it might be a whole bunch of them. And those transactions, though, can occur between all kinds of different participants, such as the bank that did the lending or an institutional investor. Think about Wall Street, so some of the Wall Street firms. Think also about selling to a GSE, and then the GSE subsequently doing something with loans and selling them out into the secondary market. And then also don't forget about servicers. Servicing assets are traded in the secondary market. So servicers or owners of servicing, if we want to call them that. There's a difference between owning the asset and the operational portion. We'll talk about that later. But the owning of an MSR, mortgage servicing right, can be traded because it's a cash flow that can be securitized. And Deb, have you heard about the Bowie bonds? David Bowie, or David Bowie. I guess it depends on how you say his name.
Yeah.
Back in the 90s, there was a cash flow from all of the royalties that David Bowie was going to be earning. And so he needed some cash to buy his rights from his previous manager. So all those cash flows, they were securitized. So he got a whole bunch of money up front. Investors bought those intended cash flows, and David Bowie used it to purchase rights from a previous manager.
I never knew that.
And then, how did those bonds perform? Well, they were great until streaming and the market changed. So,
right.
So that also is something that's very important in the mortgage market as well. As we think about back in subprime, prime days, how those bonds performed and how liquid they maybe didn't become, or their performance, lack of performance, as we might say. those types of things in a market will change the participants as well as the desired assets.
Right, and the price.
And the price, of
So
course.
that goes to a little segue here that you just made me think of, which is when we manufacture the loan and we sell it, the investors are expecting good quality in this case and to maximize the price paid and the profit that we could earn. And keep the interest rate lower to the borrower for that good credit.
So on that note about liquidity, let's go on and talk a little bit more about mortgage as liquid assets.
So think about lending institutions selling the mortgage loans to replenish their cash so they can lend again. That's liquidity for the lender. And the secondary market, knowing that these activities are frequent, it gets more comfortable with the influx of supply of those loans into the market, so they may demand more, and then that helps create liquidity. That's the concept of liquidity. So the lender, has loaned money to the mortgage borrowers. They disperse the cash in exchange for monthly mortgage payments, and the lender becomes the servicer at that point in time. In most cases, sometimes you sell the servicing immediately, and we'll touch on that later. Again, there's so many flavors, so we're going to try to stay mainstream and then branch off some more. But the mortgage buyers invest in the excess capital that they have through the purchase of these assets from the lending institutions. And as Amy referenced earlier, you can sell them to a multitude of investors, and a lot of you know about the GSEs, which are Fannie Mae and Freddie Mac, and then there's government entities. We'll talk about those more in a minute.
And then, of course, the lender has given out that cash, may choose to earn the yield, but may choose to sell the loan. Mortgages are extremely liquid assets, whether they're pooled or they're whole loans, as well as the bifurcation, so the separation between the loan and the mortgage servicing right, but a very liquid market. And to replenish cash, then selling of the loan, and the lender's made whole, ready to put the cash back out to do more loans. And the investment of that excess capital, so wanting to do that, is important. And we've certainly, as markets have changed, as mortgage participants, so more independent mortgage bankers have changed kind of the landscape, if you will, of who's lending. We've seen banks retreat, and we've seen independent mortgage bankers come in, but the need to replenish capital, or if the business model is such that it's an investor who holds on to the loans, does not sell them, those are all very different opportunities. Nonetheless, this mortgage market remains extremely liquid and available for investment.
Yeah, and I would think of all this as like, if you are a borrower, you need a loan, and you're going to pay an interest rate, and you're a lender and or an investor, you want to earn an interest rate. You want to put your capital to work so you get more money over time value of money. We'll touch on that some more later. So I've given you my cash, but in exchange, I need to get that interest rate to make up for letting you have that cash and putting it to use. So yes, some investors want to hold on to it, meaning the lender, but the ultimate investor is doing the same thing. They want to invest in that mortgage bond or that whole loan so they can receive the interest rate. And the last thing I'll leave you with before we move on is, let's say the market or the rate that the borrower is paid is 7%. He's paying 7%, but in the secondary market, we start to split up that interest rate and everybody gets a piece. Whether it's the servicer, the lenders get their profit, and the investors get their return, or the agencies get a credit investment fee. You'll learn more about this in a few minutes, but just wanted to set it up for what's to come. But this is the whole liquidity. Everybody wants access to that interest rate slice. So that just really leads me into kind of diving deeper into loans and mortgage servicing rights as investable assets, right? It's kind of a puzzle piece. Like I said, we're breaking up the interest rate. So originators may invest in their own lending, like I mentioned, or have the opportunity to purchase and sell mortgage assets through the capital markets, the secondary market. We use those terms sometimes interchangeably. So there's the the loan that you created, you can sell the entire loan. Uh, you can sell it with and keep the servicing. You can sell it servicing released, and somebody else will pay you that cash for that 7% interest rate that I told you the borrower was paying. Or, you can sell it into securities. We're going to get into that in a minute. But when you break down the most basic part of the interest rate, whether it's in a whole loan or security, you've got the loan value, you've got a value that the servicer, once that loan is closed, is going to command a payment for taking those principal and interest payments, maybe advancing them to the investor, certainly paying your taxes and insurance. And then there may be some leftover interest rate. And what do you do with that? That's called excess servicing. So just want to get that concept out, and we'll dive into it a little more.
And in those markets, there are differences in liquidity. So selling loans, as we mentioned, a very liquid market, whether they're sold as whole loans or they're pooled into securities, as Deb mentioned. The base servicing, we tend to think of that as about a quarter. But, base servicing has been different in the past for different products. So we don't know what the future offers for us. But right now, let's assume in all of these examples, base servicing is a quarter of that 7% interest rate. That's the income stream that's estimated for collection of those payments and all of the work that's required of a servicer to maintain a loan. And then, as Deb mentioned, the excess servicing, that's a less liquid market, but nonetheless is a market that exists and might actually, really be coming back. There's been periods of ebb and flow of desire for assets, but the financial markets are always innovative.
That's right. And just to kind of put a fine point on the base servicing, like you said, 25, a quarter of a percent of interest rate. So think of it that way. It's not 1/4 of the 7%. It's what we call, you'll hear in a minute, some of the terminology, 25 basis points of the rate. So just think of it as a 1/4% of interest that the servicer earns, and they've got costs to cover, and whatever the profit is between what their cost to service is and that 25 basis points or a 1/4% interest rate. And then if they have excess servicing that they keep, they get extra interest income. And you can value it and sell it if you wanted to.
And we'll talk more about the excess servicing, where that comes from. If we're talking about base servicing, if you're confused at this point, don't worry. It is confusing.
That's part 2.
But we have so many different opportunities on how to sell loans that you can structure a payment to someone. Back to the David Boy bonds, right? You can do anything. If it's a cash flow, you can sell it and structure it in a way that there is an investor who desires to be a participant in that transaction. Why don't we talk about those investors? So an investor that wants to buy something, what is it that they're buying when they're buying a loan? And who are some of those investors, and what type of thing do they tend to like? So Deb was mentioning the GSEs, so Fannie Mae, Freddie Mac, Federal Home Loan Banks, I guess, are also in there. Jenny Mae is another, we'll put them in that category, whether it's a GSE or a government-sponsored enterprise or an overt government agency. We're going to lump them all in there. But that is a very standardized market and program, and well-known and very mature, and investors like those products worldwide. So not just in the United States. But what are they doing? What are those entities doing? They are providing a credit wrapper, if you will. They're insuring these loans in the event of default or lack of payment. There are structured agreements on what these entities will do. And so generally, if you're thinking about what are the GSEs buying, they're mainly buying credit. However, they do also invest in actual loan rates for that yield. So for a receipt of cash flows on an ongoing basis. And then, lesser so, the GSEs own servicing. and they own servicing pursuant to their programs and the contracts that go along there. And then also participants are institutional investors. They are less about credit, but they may create a credit or provide insurance on a type of structure. But generally, they are yield investors, as are private investors. Both, however, are also investors in servicing. So whether it's base servicing or excess servicing, we do see them participating. So in general, all of these different types of investors, the GSEs, the institutional investors, so Wall Street investors or banks or investment banks or pension funds or you name it, as well as private investors, we might call them hedge funds generally, or real estate investment trusts and trust REITs. They are investing in everything, but with different emphasis generally based on their business strategies. Why don't we go on to some loan terminology? Some of these terms that you're going to be hearing probably have already heard, but let's kind of break them down and do a reset, because they will be inputs to other conversations that we're going to be having. And so we've talked about execution, who are the buyers, what are they buying? Residential mortgage-backed securities, or RMBS, right? That's the big bucket of a mortgage-backed security. So if it is one that's insured by the GSEs or the government, we'll talk about Fannie Mae and Freddie Mac and the UMBS, the Uniform Mortgage-Backed Security. The Ginnie Mae security is another type of RMBS, and then private labels will have their own mortgage-backed security, and it's really referencing the structure, the formal structure of taking a pool of loans and stripping cash flows and identifying payees, who's going to get the cash flow, when will they get the cash flow, what are the terms. And then separate from the RMBS is whole loan. So an investor can say, you know what, I don't want to buy a piece of cash flow. I want the whole kit and caboodle. And so purchase a whole loan. GSEs purchase whole loans, private investors purchase whole loans, banks purchase their own whole loans. Banks are our investors. So if it is a bank that is originating a loan and chooses to retain that loan, they are an investor. There's an internal transfer, and there's a whole bunch of fun accounting stuff about that too. But the whole loan is the direct sale of the loan to another entity, and that could be internal or it could be external. So basics of execution. Want to talk about rate?
Sure. So again, back to that 7% that we've been saying the borrower's paying for that loan amount. That's the note rate. It's fixed. Certainly there are other products like adjustables, but we're going to stay in the fixed rate lane. And so that is the note rate, the interest specified in the mortgage agreement between the borrower and the lender. And the whole loan investor may or may not receive the note rate or a portion thereof. Again, we talked earlier about servicing retained or servicing release. So if you sold a whole loan and kept servicing, then you would keep that 0.25% interest rate, and you would advance the payments to the investor who bought the rest of the interest rate. So if it was 7%, we're going to advance 6.75% to the investor. If you sold it servicing release, we're going to send the whole 7%. And what did the lender get? He got the price for it. And we'll talk about more there, because certainly in that space there's a lot to talk about. And back to just quickly on the execution with Fannie, Freddie, Ginnie Mae, they take certain product types. So we'll talk about those in the future as well. But they're set up for that very purpose, is to invest in, for example, Ginnie Mae, FHA, and VA. And the private market typically purchases jumbo and non-agency products, but they've gotten a little bit more into, competing with the agency. So that's interesting, but a segue.
Yeah.
So.
Well, on that point, we were talking about credit. So if the GSEs are valuing some credit aspect,
right?
For example, non-owner occupied is something that has been, since the beginning of time. People wrestle with what is really the credit cost there, and I do remember back in the 2000s, early 2000s, where Wall Street said, you know what, we think all of our analysis says that the cost of that non-owner occupied credit ding is nowhere near what the GSEs are putting out there. So, hey, why don't you sell me, Wall Street firm, what would have been naturally a Fannie Mae or a Freddie Mac intended product, and so there was a pickup. So capital markets are very efficient.
Yes.
If they see an opportunity, if any investor sees an opportunity,
They'll make a market
where they've measured something and it's different than somebody else's, make a market, wave it in. Now, are the outcomes always consistent? No. And so what may have been a good idea may be transitory.
Right.
They only be temporary and move on. But what's old, it becomes new. Much like bell bottoms and, the 80s neon. Somehow that came back again.
I know.
For a hot minute. But so as fashion goes, so do bonds.
But sticking in the rate, finishing that up, because I'd love for Amy to pick up back on the credit fees in just a second, is, okay, the whole loan note rate, the borrower pays the note rate. Then there's the security coupon, and that's the rate of return paid to the investors by the issuer of that sale, that security of loans, which is a pool of loans, on a residential mortgage-backed security, buy a pool, again, of loans versus one whole loan at a time. You can certainly sell a lot of whole loans together in a package, but the security market actually creates some tranches of interest rates that really get paid out to different components. Again, we're going to get into that whole thing. And so that security coupon is a rate in and of itself. So it's not 7%, it's something less than 7% because we're taking out bits and pieces.
Yeah. Let's go back to the GSE language, and that's most liquid and most common, but a guarantee fee, or you might hear it called a G fee. That is the price that the GSEs charge for guaranteeing the ultimate investor the timely payment of principal and interest from all the mortgages, all the loans that are within that pool of the mortgage-backed security. So we'll use pool and security interchangeably. What that means is a whole bunch of loans, all those cash flows put together, so they kind of stop being their individual selves as loans, and now are just collectively one big voice of payments, if you will. Long in the credit fee category with G fees are risk adjusters, so very specific characteristics of risk on loans. We mentioned non-owner occupied. It could be an LTV. It could be a credit score of a borrower. Those are individual risk adjusters for those loan characteristics, and would be true for a whole loan that's sold to an investor or a loan that is eligible for a pool. Those credit charges are part of the sale of those loans. A risk adjuster is about the loan itself, the loan characteristics, but a credit guarantee fee is more about the investor ensuring the general performance of the security.
Right, and the payment of the principal and interest.
Well, let's talk about that servicing. And just like the whole loans, just like loans, we have different types of servicing executions. So we've talked about released. So if the lender says, I don't want to keep this servicing because I don't service, or opportunistically, I don't value the servicing, or it's a product, a specific product. Sometimes you'll have some folks who say, I'm not keeping, complicated types of products that the servicing is too onerous, or I just really don't like that credit characteristic. Folks will sell on a release basis, and that release basis may be, what we would call flow. So consistently, loan goes to an investor as soon as it's originated. Always know what you're doing, or it could be on a bulk basis where you've accumulated the servicing and now you pick up and do a big package. So probably have heard about servicing brokers out there who help place packages, but you don't always have to have a broker. You can negotiate
transfers of those assets if you've accumulated them.
Yep. That's right. And then, of course, the opposite is retaining. And that's, fairly simplistic, but the servicing may be retained, but the loan could be sold. So that bifurcation, that separation of the asset, selling the loan in the normal course of business, perhaps keeping the servicing in your normal course of business, or opportunistically saying, we want to keep because we value this at a different rate than the market. So we certainly saw during the pandemic some displacement, if you will, of servicing values, and finding folks that decided, well, we're gonna keep this servicing during the pandemic. Others that opportunistically said, hey, I really want to invest, and we're out there buying bulk packages of servicing. So those markets change, ebb and flow, just as the loan piece does, just as the credit piece does, the servicing valuation piece does too.
The price changes, the demand for it changes, the supply may change of these assets, right? We've seen mortgage volume go up and down. We've seen global impacts on the housing market, which the pandemic is one of the most major impacts we've ever had, where suspension of payments because people lost their job put loans into forbearance, a pause on their payments, and that impacted the value of servicing. So it was very interesting. But then the government, had a program that was helping support this forbearance program as a non-credit event, but not to go down that rabbit hole, but it did impact the markets, is your point. And then just kind of coming back to your released and retained, side note, not in the presentation, if there's a lender that isn't good at or doesn't want to spend the money on servicing, they can still own the servicing and subservice, get another entity, a third party, to do that service for them on their behalf. So
that's a good distinction. So a servicer is the owner of the rights to those cash flows.
That's right.
A subservicer is the party with whom an owner of the asset engages for operational work.
Right.
Yeah. So that's always an interesting decision, where I want to own the mortgage servicing right. I like the cash, but I don't like the operational expense. I maybe can't do it as efficiently. In other words, I can't do it as least cost as perhaps a subservicer who has particularly volume, right? That's one of the, going back to our manufacturing goods comparison. If you have a big factory and you're very efficient at chugging stuff through, you're going to have a lower cost basis typically, right? And same thing if you think about subservicing, then, if you have, the more volume you have, the lower your overhead becomes, and sometimes it makes more sense.
And sometimes translates into being more profitable asset for the owner if you can get your costs down through the subservicer if you can't do it yourself. But anyway.
Well, that's a great discussion for another day, but maybe let's talk about those components.
Yeah. So into the servicing, whether released or retained is irrelevant to the components. So we talked earlier about base servicing. That is, again, the fee earned by a servicer for administering the loan, payments to the investor, paying the taxes and insurance, and it's usually presented as a percentage of the unpaid principal balance of the loan. And it's deducted from the monthly mortgage payment. So again, we said 0.25% of interest is held for the servicer. And then depending on how you take that 7%, and you might pay the GSE, a credit fee out of that interest rate, and you'll have some profit in there that you'll end up getting for yourself. And the servicer gets their 0.25% interest. And then the investor wants, let's say, 6%. But let's say you have 25, another 0.25% of interest rate left over. That's excess. So what do you do with that? And we'll go into that shortly, but you can value that, you can keep it, you can sell it. But you do have this standard base servicing of about 0.25%. And then there may be opportunities, depending on all the math and all the scenarios, where excess might exist.
Last thing we want to talk about there are some of the expressions within servicing. So MSR, mortgage servicing rights, that's the whole base or excess, doesn't really matter.
Right.
It's that cash flow that's coming through, and there's a contractual right. There's lots of legal documents that go along with a mortgage servicing right. What has to happen? What has to happen pursuant to specific investors? What has to happen for regulatory requirements? What has to happen for operational reasons. And an SRP, in contrast, is the value of that mortgage servicing right, usually shared as for a transaction. So a buyer of the MSR, the thing, right? The SRP is the value. So an SRP would be a servicing release premium that would be paid for an MSR, mortgage servicing right, to be released from its owner and delivered to the new entity.
In the pricing terminology space, there's the pricing margin, and that refers to the difference between the cost at which a lender will originate a mortgage loan and the price at which the loan is sold into the secondary market, or the interest rate offered to the borrower. And it represents the lender's profit, right, from originating the loan, and covers various costs associated with the loan process and having some additional funds left over for that profit, right? So if it costs you, $2,000 to originate a loan,
those were the good old days.
Yeah, I know. I'm just in dreamland. It's probably more like 13,000
right
now. But whatever the cost is, the lender is going to understand that and then say, I want X above that, and bake that into the interest rate. So you may start out with the market rate is 6%, and you add in your cost to service or originate, and then what it's going to cost you to service the loan, and what you want to make on the loan, and then maybe what you have to pay other people, so you end up back at that 7%. So again, we talked earlier about you got to go to the capital markets if you're going to sell the loan, and figure out what you're going to do with it once the loan closes, and then you certainly build in the biggest piece for yourself. I say the biggest piece. It usually is, not always, but you build in a piece to make your own money after paying everybody else.
And that pricing margin can differ for all kinds of different reasons, products by product, by channel. So some channels are more expensive to manage, have greater costs than others. You could have different market conditions or competitive environments,
right,
where you as a lender or as an organization are willing to subsidize or take less. That's really what subsidy means, is take less. And again, think about your goods manufacturing, loss leaders. The turkey that is on super duper sale at Thanksgiving, so you'll spend the money to buy other things. You have some cross-selling opportunities where institutions may value that relationship and create a subsidy. So pricing margins will be different from lender by lender, entity by entity,
and market condition by market condition.
That's right.
So the volume is so low right now in the market. There's a smaller pie, and a lot of people at the table trying to eat that pie.
Yep.
And so lenders have been reducing their pricing margin so that they can get the volume, and they want at least. So there's always this: how do you price to get the volume, and then the dollars that contributes to cover your costs and make extra money. So you may increase or decrease that pricing margin to optimize what you can make sure you get the volume you can handle.
Yeah.
So that's fascinating piece of business.
And during the pandemic, when rates were so low and refinances were, you couldn't walk outside without getting slammed in the head with a loan application, right? Everybody was running to refinance, and operationally, organizations may not have been able to handle it. So they would have a bigger pricing margin required, simply because from a competitive standpoint, they had all the business that they could do. They would be failing in their service to the client if they took additional. So again, market's changing all the time. If there's one thing about capital markets, is that it's never the same.
That is right. I've been doing this 41 years, and even this market cycle, I can't say anything has ever been, that's just like.
Right.
So pricing margin is something the pricing desk in capital markets looks at all day during the day and is ready to figure out what to do the very next day when we put the rates out. So it's a fascinating piece, and it does vary. So the next piece you've heard me talk about is basis points. A basis point, usually written out as BP, or you'll hear it called bips. So how many bips is that? Is a unit of measurement used in finance to describe a change in the interest rate or yields. Usually, I mean, you certainly can express a rate in basis points, but we use it a lot to talk about changes. And it represents 1/100th of a percentage point. So if you have 1% interest rate, that's 100 basis points. So just keep that in mind. You'll see that expressed later in some of our math examples. And then pricing multiples. This one's pretty complex, and we'll be talking more and more about this in our future series.
It's good old math.
But it is good old math. And it really is. If you think, again, you hear me always saying, take the interest rate and how's it broken up and how's it valued. That's all this really is. So let's talk about pricing multiples. This is a lot of new terminology you're going to hear, but we're going to try to keep it simple as we demonstrate some of this later. It's a metric, the multiples. They're a metric used to express the value of mortgage servicing rights, or even the GSE guarantee fee, buy up or buy down ratios. So we'll talk more about that shortly. But a pricing multiple is the ratio of the market value of the relevant income generated by cash flow of that asset. So just digest that again. Our PowerPoint's going to show you all the things we're talking about, and we'll talk about more of this in a minute.
Well, I have a confession, because it took me a while early in my career to really understand multiple.
Right.
And finally, I can't even remember what the moment was, but a light bulb went off over my head, and I realized, oh, it's a ratio, a fraction. So if I am saying something is 2 to 1, all you folks who gamble, right? You've got odds of 2 to 1 or 100 to 1 or whatever. That is what we're talking about here, is a ratio, and it's a way to express a percentage point or cash flows or other mathematical concepts relative to the unpaid principal balance. So a lot of our pricing conversations as percentages, we're going to be talking about how you actually speak of price. It's all about the UPB, the unpaid principal balance. So don't worry if you're a little confused.
Yeah, don't worry. Don't try to absorb this all right now. But really, these are all expressions that are used in contextual dialogue, when we're working with mortgage assets,
right,
in the capital market space. And I'll give you a real quick example. 1%, so the ratio 2 to 1. So that's going to be 0.5%. Because 2.5% equals 1%, right?
Yes,
so,
that's a great way.
For a 4 to 1 multiple is 0.25% of interest rate to the 1% of interest rate. Yep. So that's how I ended up having my light bulb moment, is just doing the math.
Yeah, we can convert rate to price by using a multiple.
Right.
Well, and that's a great segue into how to speak mortgage. So we were just talking about the conversion ratio of multiples. Well, investors speak one way, borrowers speak another way, finance folks might speak another way. So let's just kind of break those down. So first of all, investors, they're speaking in terms of a dollar price. So you might hear someone say, oh, it's 99.75 or 102.5. That's a dollar price, and that is a percentage, again, referencing the relevant UPB of whatever asset it is, whether it's a security or it's a loan. It's speaking of the percentage. So describing the value of securities, describing the values of whole loans, not describing the value of servicing per se. So an example is, I am going to be paid $99 for this whole loan. If it's $100,000 UPB, the cash I'm going to get is $99,000. From a borrower perspective, though, we tend to speak in terms of percentage points, and so they convey generally the cost for the borrower, or in some cases a rebate above 0, but it could include discount points or origination fees or other loan related charges. So if we're talking about what a borrower might pay, your note rate is a 1 point cost. That's how we tend to speak with borrowers. And then finally, on the finance side, as Deb was mentioning earlier, basis points. So it's a unit measurement, and it, as Deb was saying, it represents 1/100th of a percentage point, so 0.01%. And 1%, 100 basis points equals that 1% that the borrower was paying, which also equals the 99 that the investor is paying. So it's really the inverse from the dollar price is the borrower percentage, and also then converting the borrower percentage to basis points. That's kind of the flow here, the way that I try to keep it together.
Yes, and then just another way to think about it is if you're going to borrow $100,000 and you're going to pay, you're quoted 6% interest rate by your loan officer, and a 6% interest rate is less than what the investor wants, they're only going to pay you 99 cents. So they're going to pay you $99,000. Well, now you're short because you're going to loan out $100,000. So you're going to charge the borrower 1 point. So 6% and 1 point, that's 1,000. The 99,000 from the investor, the 1,000, which is 1% of the 100,000, makes the lender whole. And so that's really the big takeaway here. And how you express it, points, dollar price, basis points, it depends on the context and who's talking.
That's right. So in capital markets, we're generally going to speak in terms of dollar pricing, but let's kind of walk through, we kind of already did, but let's just review this real quick with some math in front of you in the presentation. So dollar pricing, describing generally securities and whole loans, while the borrower pricing is generally expressed in percentage points. So looking at the grid here, dollar price of 99, the equivalent would be the borrower percentage would be 1%, and the basis points would be 100 basis points. And we'll do a little math here. So multiplying the $100,000 loan that we were hypothetically describing by 99%, because that's what dollar price of 99 means, 99% of the UPB. That equals cash of 99,000 to Deb's example. The borrower equivalent, if you will, in this transaction is paying 1%. So that's $100,000 multiplied by 1%, $1,000. The 99 plus the $1,000 equals the $100,000 that Deb was just describing. And then if we were just going to describe the basis points, again, $100,000 multiplied by 100 basis points, and then converting it with the 0.0001 factor, we get ourselves back to that same $1,000. So again, the UPB of $100,000 is the reference point for converting into these multiple languages. And then one other important part of speaking the language is reference to the relative value of a dollar price or the equivalent percentage point. So again, expressions of value are, if we're looking at a dollar price, that's a percentage of the UPB. And so 99 is less than 100%. So we call that a discount. 100%, we refer to that as par. If you hear dollar price of 100, usually traders won't speak about 100. They'll say par. I'm being paid par for this, or I'm being paid 99, or I'm being paid 101. Nobody typically says I'm being paid 100. I'm being paid par. But it's all saying the same thing. It's just a reference point. So above, at, or below par.
And again, the premium is that investors getting, or lender investors getting more interest rate than the market. So he's willing to give you essentially what turns out in the closing is a cash credit, lender credit, like we just said.
Yeah.
So again, par is what's the interest rate you think the market's commanding. So I'm not going to charge you anymore or give you points or give you less price. So that's really
Yeah.
how you're making up, and really the basis points describing the change between the price, right? The 99 cents is 100 basis points from par. So we're going to charge the borrower 1% if I
Yeah.
were talking to my folks in the pricing team.
Right. Along with that, though, so we talked about par, premium, discount, that relative position in the marketplace for what investors demand based on a variety of different market conditions. There's kind of a key principal concept, and that is the relationship between price, and we're going to refer to it as yield. So it could be any type of asset. We'll call it yield. What do investors require? So yield is calculated, just very dryly here, based on the bond's fixed interest payments, so what you're expecting to get as an investor, relative to the current price of a security, of that security. So if the price increases, the fixed interest payments represent a smaller amount, a smaller return. So the yield goes down then, reducing the yield. If the price decreases, the fixed payments represent a larger return, and therefore the yield of that invested asset goes up. So inverse relationship between price and yield. Graphically, we've tried to help depict it here. And so as we think further about the relationship between price and yield being inverse, when the price of a bond rises, so the value of that security goes up in price, what it means is that its yield falls. And then conversely, when the price of a bond falls, its yield rises. So you don't have to grasp onto that and understand it in the depths of your soul. It might take a while. If you are curious, you can go look at how cash flows are discounted. And if you're a math person, and that really helped me, I hate to be the nerd that admits it, but when I could see mechanically in the equation how that change in bond price affects the yield, or the change in yield affects the bond price, that really did help me. But just for all of our understanding here, there's an inverse relationship between yield and price, and substitute the word rate for yield, and that's where we can see on the rate sheets in mortgage how the market changes. So what was your 0 point quote yesterday might be, if the market got worse, and we'll be thinking about that in terms of price, your 0 quote, if it was 6%, now that 0 quote might be 6 1/8.
Correct.
Rates got worse, and again, it's all directional, right? For whom? Rates got worse for borrowers, but for an investor,
right,
maybe that's better for a higher yield. And then vice versa, if the market got better, then instead of 6%, 5 7/8, right? Maybe at that no cost. So it's all about pegging the starting point, and then what your reference is. You could start with price and like we did, and reference rates, or you could start with a rate and reference the price.
That's right. And just to ground it, it's we always look at what's the par rate, which is really what the market perceives as the market rate at that point in time. And so those rates or yields will go in the opposite direction. And that's why when you look on a rate sheet, you're going to see as the rates go down, the price or the points to the borrower goes up. Because think about you being the investor. You're not getting 7%. You're only getting 5 7/8. So hey, I'm getting less than where I can invest my money elsewhere. So I'm only going to pay you 99. And you're like, okay, but then you're like, well, I can't be short $1,000 on my 100,000, so I'm going to go get that other piece from the borrower. So again, this all goes back into the circle, but the concept here is the inverse relationship of yield or interest rate with price and points.
That's right. Well, that concludes our basics here of pricing and our fundamentals. Hope you had a little bit of fun, and we'll be continuing the series with a deeper, next session is really into the pricing components. So get ready to cook up some fun with us. That's a little bit of a teaser on how we're going to try to help you learn and reference all these components of mortgage pricing. Thanks so much for joining us, and we look forward to seeing you again soon.
Don't forget to send questions.
Absolutely. We're here to answer anything and everything.
Thank you.
Thanks.